Who says you can't print an antidote? Hello and welcome to today's Daily Blitz. As you can see, my co-host Nikolai has returned from paternity leave. He is now a proud father, but he is now back in the office and we'll be continuing with our normal Daily Blitz video format. But in today's video, we'd like to dwell on what's going down in Chinatown.
Or rather, what is not going down in China.
Which happens to be stocks, or it would appear to be so far. So despite all the fear that's been created by the coronavirus and all of the threats to global economic growth, interestingly, stocks worldwide don't seem to be doing much about it. So this is the Seng Volatility Index you can see there. And what this is a measure of how expensive insurance is on the Hong Kong stock market. So it's measured through options contracts and it's just showing you how expensive it is to hedge against a major move up or down in Hong Kong stocks. And as you can see, if you take a zoomed out view, the Hang Seng Vol Index has been significantly higher just over the last 5 years, let alone if you zoom back even further on. So it seems the coronavirus does not seem to be affecting sentiment majorly on the Hang Seng Index as a whole. So if we observe that trend, and then we zoom out even further from just China, and we look at the G7 countries, here on your screen now, you can see the JP Morgan G7 Volatility Index, and that is currently at all-time lows, going all the way back to 1992. So why is it that volatility is just so low when it comes to global stocks, despite us having a pandemic on our hands and all of the other problems that we've been used to over the last few months?
Yeah, so when the pandemic first started, it was all about the idea that, well, central bankers can't possibly fix this problem because you can't print an antidote. But it looks like the opposite is the case. Since the pandemic has affected markets, central banks have started printing a lot of money, especially in China and the US, usually through swaps and repos. But that has actually worked to calm the stock market, which suggests that, at least as far as financial assets are concerned, central bankers really can cure pandemics, which is a totally bizarre a new concept. And it sounds ridiculous, but that's what the prices are telling us.
Or at least it appears they can cure the market's reaction to a pandemic so far. It should also be noted that there's been an increase in popularity in an investment strategy known as volatility selling in recent years. And this is where you effectively sell insurance on the stock market in order to earn income. And this is something that pension funds, among many other major investors, have begun doing because low interest rates mean that they struggle to find income from anywhere. And it may be that, sort of as a global coordinated strategy, is really forcing volatility everywhere down, even if it really should be a lot higher than where it is now.
The real risk from all of this is that if volatility does spike up, it has a long way to go because it's starting from such a low base. And we've seen that happen in the past where the VIX explodes higher, suddenly wiping out those volatility sellers and getting a lot of funds and private investors into a lot of trouble very quickly.
But so far, it does seem like the central banks have managed to print an antidote to the market's reaction to the coronavirus. But it's something that we should all be keeping a close eye on. But that sums up today's Daily Blitz. Thank you very much for watching. Be sure to subscribe and click the notification bell down below, and we'll see you in the next one.